The main difference between cash and stocks and shares ISAs is that a cash ISA is really just a tax-free savings account and your money is always held in cash. A stocks and shares ISA is an investment portfolio that is held in a tax-efficient way. There is no income or capital gains tax payable on the investments, although the 10% withholding tax on dividends cannot be reclaimed, so a stocks and shares ISA is not strictly tax-free. You can hold most investments in this type of ISA, such as funds, investment trusts, exchange-traded funds and shares, although not shares on AIM. You can also put more into a stocks and shares ISA. For this tax year, it's £10,200, providing you don't have a cash ISA. For a cash ISA, you can put in up to £5,100. The best type of ISA depends on your objectives and if you're happy to take risk. If you want access to your money at any time and are saving up for something, for example you want to save for 6 months to buy a new car, then a cash ISA would be most suitable. There is no chance of a cash ISA losing value, unlike a stocks and shares ISA, which may fall if the stock market falls, for example. If you are saving for a longer period of time and are prepared to take some risk, then a stocks and shares ISA may be best. Over long periods of time, the stock market nearly always outperforms cash, and by a considerable margin. So you are more likely to build up a bigger pot of money, but remember, it could be a bumpy ride. Is a cash ISA a good idea when the Bank of England base rate has stuck at 0.5% for almost 2 years now? Well, it's not only that, inflation is increasing, and as we know in January it hit 4%. The average cash ISA pays out just 2.27%, which means most savers are losing money due to inflation. So to get a real return on their money, some people are now opening stocks and shares ISAs, as the stock market normally outperforms cash. However, beware of just switching out of cash and putting everything into a stocks and shares ISA. Firstly, a cash ISA is good for short-term savings. You can dip into it for urgent big purchases such as a new boiler. And secondly, there is really only one way interest rates can go. Many experts predict that interest rates will rise later this year, maybe even this summer. So when they do rise, it makes sense to have your cash savings wrapped up in a tax-free wrapper in a cash ISA.